It's a pleasure to be here, and it's also not bad going last. I don't feel like I have to fill time, but I think importantly there are a lot of good themes discussed by William and Bill and Jessica. I get to actually talk about the longest time frame, even though in my day job I'm dealing with a lot of investor clients, principally hedge funds, whose idea of long term is sometime mid next week. So it's all about who do I trade in and out of the auto show? Is the F-150 going to be positive? But I'd like to really kind of talk about the impact of three longer-term megatrends on the auto industry. So the three megatrends, and some of the other speakers have commented on it: the rising U.S. oil supply stabilizing prices. Second, and sort of the taking off where Jessica ended, we've got fewer youth in developed markets, and the youth that we do have are poorer. We think that has big implications for the industry. And then finally, there's this trend, we call it the connected car, always on, always connected consumer broadly, bringing in the connected car. So let's talk about those three mega themes. As the first two speakers indicated, we're in a new era of energy production. You see for the first time here, this looks at non-OPEC supply growth versus global demand growth. In 2013 and then again in 2014, we expect that to exceed. We expect the growth of non-OPEC supply, which is primarily U.S., primarily shale oil, to exceed the global oil demand growth. If you look at that, and if you kind of think back to 07, 08, the 140 we hit at the peak in 08 really, I think, kind of understated the panic in the market, as Jessica alluded to. We all thought, not me, but many of my clients thought that oil was easily headed to $200, maybe $300 a barrel. And as Jessica pointed out, that really affected the mood of car buyers and what kind of commitments in terms of their vehicles they were going to commit to. Rapid fall off in pickup truck share, SUV share, really the dependence of the industry on the profits from those vehicles fell apart, or the companies fell apart because they no longer had those profits. So if you look at the prices here, they're not particularly cheap by standards of kind of the Clinton era or earlier, kind of, we're not $30 a barrel. But I think the key point is this rise in supply combined with the availability of natural gas as a substitute for many industrial and other uses has really given, we would argue, the consumer confidence that we're not going to see $200 in oil. And maybe it could actually, in our Barclays forecast for the year, could come down a bit in 2013. And these prices are pretty good, especially when you consider the geopolitical uncertainty. Second mega trend, we in developed markets and some developing countries even like China, we're getting older, so this just looks at the median age, and this is probably the one thing you can predict with the most certainty in out of anything, which is how old are people going to get. And you see we start higher in developed markets and we're getting older in developed markets. And then you combine that, and I know 15 to 24-year-olds aren't buyer groups, but numbers look similar if you go to the 24 to 35-year-old demographics. If you're in a developed markets, not only are there fewer younger people, they've got higher unemployment rates, and just structurally higher than they had been certainly in the boom times of the 90s and the 2000s. The other thing I'd point out in the U.S. is the student loan debt. The Federal Reserve Bank of Kansas City calculated that the median monthly payment on student loan debt was $180 per month. My calculations, which may not get in all the forgiveness programs, got me closer to, for the average, $350. I think that's an interesting number because about a new car payment's about $500 a month. Maybe an entry-level car might be $300 a month. So if you've got $180 right there going into student loans, if you're underemployed, as Bill pointed out, maybe not in what your degree prepared you for, do you really have the money for a new car? And then finally, always on, always connected, maybe the more positive aspect of this story. We all know about the global growth in smartphones. And then what we do know, and this is a survey Harman did, a big supplier, a couple years ago, it's probably even higher today. People expect to stay connected while they're in their cars. Okay, so what do these mega trends mean for the automotive industry? And I'll go through some of these. First of all, we think that stable oil really has three big implications, two of which I put on here. We're seeing not just in the U.S., as Paul and and Joe pointed out a boom in SUVs, CUVs again. We're seeing it really around the world. Second corollary of that is we're getting an increasingly crowded mid-car and small car market in the US and Europe. And actually that's when I drew an arrow there, reinforced by having fewer poor youth. You always think about those, and I'm sure if you go to the floor here, you'll see happy late 20-somethings enjoying small cars. That's the market some of you who are product planners in the market no doubt thought you were going to get into. The fact is they have fewer licenses, they're not buying cars, and it's us old folks who are buying the SUVs and SUVs. The other implication is the EVs are going to be primarily a niche, and if you look at the Tesla, it's selling just as much on being faster than an Aston Martin, I'd argue, that on being a electric vehicle. USU reaching normalized growth, 16 million SAR. Emerging markets, yeah, with the taper in the US, they've taken a hit, but still the growth engine in terms of demographics over the next decade. And then really, I think a few people have touched on this, the always on, always connected could really mean that the basis of competition in automotive is shifting from mechanical to electronic. So let's go into some of those. I would argue the trend towards SUVs is really an unintended consequence of the footprint and weight-based fuel economy regulations. So those of you with a kind of eye to regulatory history, remember the Bush administration put in the footprint-based CAFE requirements, and the idea was, and I seem to remember some environmentalists opposed it at the time, is look, people in Texas, where some of the Bush people were from, are going to want to drive light trucks having better fuel economy than they did. You combine that with stable oil, and they say, look, I can basically have the same gas bill without big risks of going it up as I used to by buying a CUV, and I don't need to downsize. So you're seeing here, I mean, we all know the numbers for light truck and pickup in the US, but the growth in China in particular, also surprisingly for all their preening about small cars, in Western Europe around the what I think LMC here, or HS calls the SUV-B category, we think of it as CMEs, pretty astounding growth. On the left, we look at sales growth in the category versus the underlying regional production growth. How many basis points does it exceed it? So you see about 2,000 basis points, or the SUV market in China grew 20%, 20 points faster than the underlying market, so about 28%. You see in Europe it's growing about 800 basis points higher than the average. Ditto in China. On the right are IHS's, many of you in the audience, forecast. You see they're expecting SUV as percent of regional sales to increase, particularly in China. The number just for the back of your head is 27% in the US. I'd actually argue, with all due respect to IHS, we could probably see faster growth than this. This is sort of reflecting, well, it grew a lot in the past, but it's got to have to slow down at some point. I would actually argue as long as the oil prices remain stable, if they come down, you could see faster growth there. So moving to the kind of demographic impact before we get to small cars. This is data from UMTRI. Basically, car buyers are getting older. That's the combination of fewer young people, few of whom have licenses, higher student debt. So you see that the 25 to 34-year-old segment sell from 15 to 10% of sales. The 35 to 44-year-old segment fell from 29 to 22% of sales. And those people who, you know, the automakers like to ignore in their advertising account for an increasing portion of sales. So we would argue that this is really what's driving this stagnation we're seeing in small and mid-car sales. So you can see the trend here. Cheap oil prices in the 2000s, small and mid-car segment lost segment share. That big oil price spike, my God, I can't put an SUV in my driveway because how am I going to run it when oil is $300 a barrel, led to a resurgence of the category. And then really in the recession, you had the only thing start falling off a bit, little spike, and there's some noise there. That's obviously the Fukushima earthquake led to a dip in 2010 and then a recovery in 2011, 2012. But really this year we saw it fall off again, and it's really a crowded market. So I think a lot of product plans were put into place 08, 09. We got to get small cars out there. It's what people are going to go to buy. So the good news is, you know, market shares are fairly well dispersed there, and the price points have changed dramatically for the big three and the Koreans. So this looks at the JD Power numbers, and you see really a convergence there. Actually surprising, now we have the big three ahead of, in 2013, the Japanese and average transaction price. So the idea that the big three is inferior product, that's obviously changed. So that's the good news. The bad news is that puts a lot of cars at very similar price, styling, and quality standpoints. So our question, really for the next 2 or 3 years isn't, is the auto market pricing going to collapse because the Japanese have a yen? I mean, traders think it's high because it's 103, but most Japanese auto executives remember it was 120, 130, 150, 180. I would argue it doesn't seem really high. It's really this one segment, two segments we worried about: small car, mid cars, declining segments, crowded marketplace, product really at a parity, where pricing may be at risk. In terms of the normalized demand, we're clearly in the camp of our forecast for next year is 16.2 million. We think that's the normalized level. A lot of younger clients sort of, just to look at 60 years worth of history, say, well, look at those rebounds in the 60s, 70s, look similar if you go back to the 50s. Isn't this pretty symmetrical that every time you have a big downturn, you get an equally symmetrical upturn? And I point them as support for my forecast. Look at that period in 93 through 95. We basically got back to the trend line but didn't overshoot. Those of us who were around at the time remember that as a jobless recovery. Remember the sort of worries that the new jobs were created were in McDonald's, and they were created in Chinese factories. They weren't being created in high-wage U.S. industries. So one of the things I think